HedgeNordic, your single access point to the Nordic hedge fund industry. 2020 turned out to be the best year of returns for managed futures in a decade. HedgeNordic is therefore pleased to share insights into the CTA space with you from some of the leading experts. Joining us are Alex Greyserman from ISAM, Gernot Heitzinger from SMN, Kathryn Kaminski from AlphaSimplex, Martin Källström of Lynx Asset Management, and Aspect Capital's Razvan Remsing. We revisit how CTAs dealt with the challenges and opportunities of the COVID crisis, return dispersion, talk about risk management and drawdown protection, complexity versus simplicity of strategies, as well as innovation in the space.
2020, of course, was an extraordinary year in many aspects, none the least for financial markets, and especially when we look at that period from late February into April, where we had very high volatility in the markets, partially liquidity dried away. Maybe Alex, can you take us back to that period, how maybe a traditional CTA experienced it, but especially also for you?
Yeah, sure. I mean, 2020 was exciting year. It was a year of very high dispersion in the industry. By our calculations, it was the fourth largest dispersion in the 20-year history of the SG Trend Index, second largest just in the past decades. So the returns were kind of a bit all over the place. The average correlation between at least the SG Trend Index managers worked out to 0.62, which was actually the lowest in 20 years. I think there are basically four factors that contribute to the dispersion in 2020. One is the purity. Seemed that non-trend strategies had a difficult time, especially in Q1. Trading speeds was a big factor. Faster systems did much better. And notably, medium-term systems actually did relatively poorly throughout the year. If you were extremely slow, you probably did fairly well, but medium did poorly and faster timeframes did quite well, not only in Q1, but throughout the whole year. Sector allocations was a big factor. Certainly if you had more commodities, especially energies and metals, you did much better. Financials were quite mixed. And then the fourth factor is alternatives. This is interesting to me. This is an area that had quite a bit of dispersion last year. Alternative markets. We trade a number of alternative markets and we did fairly well in them, but I've noticed at least two alternative market specialists actually lost money for 2020. So it'd be interesting to me, perhaps there's an issue of credit markets or something else, but there's a tremendous amount of dispersion in the alternative space. So the combinations of purity, speeds, sector allocations, and alternatives, or what kind of alternatives you traded, made the difference. But overall, the SG index made over 6%. It had a daily basis minus 0.08 correlation to the S&P. So the industry did, relatively well. The trend is dead, sort of. Articles are at least pushed off for a little while here. So things are looking okay for the industry, I think.
It was a year of challenges, in particular for us, obviously enjoying a really strong 2019. And I think that complementing what Alex just said, 2019 was a very strong year as well for CTAs. And we had some really solid exposures coming into 2020. And parts of those were in equity markets in our case. So when the Corona crisis hit in mid-February, we had a solid exposure in equities, a net long exposure in equities, and that was a painful position. And as we moved out of that position and eventually net short equities, the market started to recover. So it was a very difficult market to trade in for our point of view in equities. But fortunately, we take a multivariate, diversified approach. So other asset classes held up quite nicely in terms of opportunity sets. And to Alex's point, commodity markets, oil in particular in the first half of the year. We had really interesting opportunity sets trading the oil markets, and in the latter part of the year, the metals and agriculture markets showed up very interesting opportunities.
Alternative markets was something which held up very, very well in our portfolio. I think it did even better in Q1 than it did during the other quarters, at least in our portfolio. But I've seen the same thing which happened to some of our peers there, where I don't know, but I suspect that's coming from credit, which we do not use as an alternative market, does not see as an alternative market. What has been the greatest challenge actually was not so much liquidity, it was the concern of some of these marketplaces maybe getting closed during the crisis. So that was something in Q1 that bothered us, or April maybe, when figures were moving upwards and upwards, so infection figures. So, and I think it was just on the Philippines where I saw 2 days market closure or something like that. But this is something we had to do some interventions, because from a risk point of view, if you're trading a spread where one leg is closed and one leg is open, it's nothing you can stand from a risk perspective. So of course you had to take out some risk, but it was not so much on the liquidity side, and we did not have any problems with the brokers. It was more the fear of some potential, I don't know, political reaction or overreaction by regulators or something like that, that puzzled us. On the other hand, so year turned out quite okay. We were up double digit in the main program, and in the alternative it was up 7 or 8, which is okay. Nevertheless, volume wise, it was quite disappointing. So every exposure we see from trend specific fund of funds is decreasing, and we do not really see the appetite for trend managers coming back with clients so far. So I think we need to it will take some time to gain confidence there with some of the investors.
How does the COVID crisis compare to previous financial crises? What are similar treats or main differences you see?
Yeah, so this summer, a couple of times this year, we wrote some interesting insights pieces where we were looking at what happened this year compared to other years. And the key 3 takeaways that was interesting in this paper is, if you take a look at this COVID crisis more in terms of the drawdown, we really saw a much bigger speed than we've seen. So that's how much pain relative to how long it lasted. It was much more painful than the other ones that we've experienced in the last 30 years. And what was interesting about this is that we saw certain characteristics, and Alex alluded to this, in that certain characteristics were better suited to deal with that type of difficult shock. So as markets really sort of went into a massive panic, it was both being more pure trend and also being faster, that had more able to deal with that sort of very aggressive move. We also saw that non-trend strategies and other sort of often implicitly short vol strategies really suffered in that environment. Whether they were based from machine learning, pattern recognition, ARP, it was really a shock to the system. And a lot of these strategies really felt the heat of that particular shock. And so all in all, it was nice to see that pure trend methodologies really did well in such an extreme environment. But we also saw massive dispersion related to volatility and the way that people manage their volatility. And I'm sure we'll talk about this a little later, is that if you looked at volatility from a relatively slow moving perspective, you just couldn't move fast enough. And so what that meant is that volatility went from being very, very mild to very, very extreme. And so some of the things that we saw that worked was having much more intraday information, trying to have smoother methods for measuring how volatility would be measured, and reacting more aggressively during that event. A simple example would be the delta between the Credit Suisse index and the SG Trend Index. That was huge. And the Credit Suisse Index is a much more rules-based, simpler methodology that uses much longer windows for volatility. And in backtest, honestly, volatility doesn't matter much. And Alex and I have looked at this before, so we know like it really doesn't matter that much. But in this one quarter during COVID, it mattered. What you did with vol could make a huge difference compared to one of your peers. And so that's something that we've seen a lot of investors talking about, a lot of investors asking us about, and sort of thinking about, is volatility going to be treated differently? Is this sort of our mini version of portfolio insurance, but the modern approach where volatility targeting and other things were very much put to the test again this year?
To Alex's point, speed, differentiation between slow, medium, and fast, I think is actually a much bigger theme than even asset allocation, because we found that not only in directional strategies, but even in the non-directional strategies, that was actually the biggest differentiator between performance several times last year. So clearly there was the big crash, which was the sort of the accelerated economic cycle compressed in a few months, but also later in the year where we had the vaccine surprise news and how markets rotated there. What we found was interesting was that directional and relative value models, provided they had no, as Katie mentioned, no short vol bias, which we tend not to try to capture. We think that's quite a dangerous place to play. That speed was very, very lucrative. We were able to react. But where it came to non-directional models, it was actually the data types, sort of whatever input data you use to form your signals mattered hugely. And there we found that alternative data sets, or any sort of data sets that infer sentiment, and you can infer sentiment either outright from, you can do it from option market data, you can do it from surveys, you can do it from term structure data. So there's lots of places that one can harvest sentiment information. Those types of models were able to adjust to the fact that the world had changed overnight. It was a sharp edge event. And we also know that quant models are traditionally, well, they're very challenged when you have to navigate a cliff edge, whether it's in risk space or in signal space. So those sentiment models really helped in a relative value sense as well. And then, to Katie's point about how we handle risk, sort of volatility risk, it's such a key ingredient in our calculations. And yes, I would agree. We've also looked at this, and volatility doesn't really matter most of the time, but it is probably the most important next factor to look. And I think, because to us, vol appears in two places conceptually. One is from a risk event point of view, deciding, okay, how much do I want to size my portfolio when I observe such an environment? And the second one is, what does this risk observation mean for my view of the world going forward in terms of how risky is the next sort of period, and therefore what conviction should I have in my signals based on what I've observed? So the question is, how do you treat these unprecedented numbers? Do they stay in your data set for a long time? Are we going to care about what happened in March, in September, or not? So those questions are quite fundamental to understanding last year, but speed, data sets, and then risk management.
Risk management, of course, was a crucial factor last year. And turning to Alex, Razvan just touched on it, but do you believe that working in some of the events and some of the learnings, some of the findings we had in 2020 will be relevant for risk management systems going forward? Or is that something that is going to be worked in to stay? And what major adaptations, if any, have you seen or thought about when it comes to risk management?
Yeah, sure. Well, I've been thinking about this for 3 decades in the industry. You know, do you build models that are data mined to recent events, or do you build models that are more robust for the long term? So we have features in our risk systems that don't necessarily make things better long term. They're kind of a wash, but they're meant to deal with these types of sharp events, with certain measures of vol floors or vol, caps, or it depends how you look at things, or just short-term measures or adjustments to volatility, position sizing. I mean, we do it intraday, multiple times a day. Those things tend to, Katie and others mentioned, kind of wash out over time, but they're quite important to shock events. We tend to create a lot of synthetic data and a lot of price shocks just to experiment in our back tests. Rarely do we look at the actual back test of the last 20, 30 years. So it's not a major shock, so to speak, to us, that a shock happened that stress tested the environments. We feel that we do the right work to prepare ourselves for things that we don't know that may occur. And we've actually made some recent improvements and over time, and continuing to work on more real-time balancing the portfolio to real-time shorter measures intraday and so on. That's just evolutionary research enhancement throughout the years to deal with things. I've been a fan, and people read in your book with Katie, a fan of long-term data sets and almost brushing away the actual 20, 30 years of actual back-tested data, which can take you down a really dark path.
And I just echo it's a key. It had during last year, it was a very important element to get right, and a very challenging one as well, to be honest. And I think for our part at Lynx, we've certainly learned some things from experiencing the previous year, and do really think that we have a better system today, better way of forecasting volatility.
Are CTAs giving up performance and being too focused on protecting from drawdowns? Maybe Alex, play that one back to you.
Sure. Drawdown mitigation obviously is very important to ensure that clients can hold the investment, right? I mean, the number one job of a CTA is to make sure that your clients actually hold you through drawdowns. Otherwise, what's the point? And I do believe that some managers are giving up returns and sacrificing some of the important features that we always talk about, whether it's crisis alpha, low correlation, skew, all those types of things. I do believe that some managers are chasing the sort of higher Sharpe ratio world and sacrificing those metrics, including things that are more correlated to traditional assets, certainly lowers drawdowns. I mean, that's the point. That's the reason why we're in combination with traditional assets. But the increase in correlation makes it worse in a portfolio setting. And I mean, as an industry, we're never going to have somebody give us 100% of their capital. We're portray ourselves as the ultimate portfolio diversifier. I've written quite a bit about diversifying the diversifier kind of risks. Now, institutional investors understand these kind of trade-offs. They understand volatility targets. Many of our institutional investors actually invest with us at higher volatility and therefore higher drawdowns, but this enables them to more optimally achieve the diversification benefits. The mapping between volatility and correlation and returns is not that well understood. We wrote a paper about that recently. I mean, the bottom line is low correlation is important, but how that trades off with volatility and returns, I mean, correlation is quite important. I mean, last year we were substantially less correlated to equities and have always been over the years relative to the industry. So it's important to reduce drawdowns, but in the context of your mandate. We do that by intensely working on diversifying the trend system itself, more markets, more breadth of speeds, better signals, better portfolio construction, all the sort of things we've worked on over the years, but I'm very skeptical and critical of people that kind of just mute drawdowns by either just artificially lowering vol or putting things in that are actually detrimental to the portfolio metrics of critical portfolio metrics of a CTA.
I think we have always been quite strict on sticking to where we are. So nobody has ever accused us of reducing our drawdowns, unfortunately. So we have always stayed quite trendy, but the fact is the more other systems you add, you might mitigate your drawdowns or reduce your drawdowns, but then other things might happen. What might be the problem is in Q1, when you compare that the drawdown was in some of the equity markets comparable to 2008, and a lot of CTAs did not perform like in 2008. But this was just a matter because volatility was rising that sharply, and that the whole thing just happened over 3 weeks, and therefore it was impossible to do the same performance numbers than you did in 2008. But I don't think that the industry is to blame for that, apart from the fact that some might have moved away from that classic CTA model, which is more strategies, different type of strategies, non-trend strategies.
I think the CTA industry has evolved. It entails today many different type of strategies. And I do think the most important, the critical element here is, first of all, to realize that there's a trade-off between generating risk-adjusted returns and providing drawdown protection to portfolios. There is a trade-off here, and it's explicit. And you need to be very transparent about the objective you have so that you have that in common with your investors. And if you make sure you have a common understanding of the objective, it's all about providing transparency around this, how you are optimizing your portfolio towards that objective. And in case of our program, the flagship program, we have provided a particular return stream over many, many years. And we know that our investors appreciate and think that a very important element of this strategy to provide diversification and drawdown protection. So we keep that intact. We're very deliberately trying to keep that intact, the return profile of the flagship Lynx program. But with that said, there's also other type of objectives that one could have in constructing a managed futures program. And Lynx Constellation is one example of this, where we're using essentially the machine learning models that is also in use to some extent in the Lynx program to construct a program that has no drawdown protection objective. It's an absolute return, pure alpha type of program controlled for correlation to other asset classes, but not to provide any drawdown protection. But I am concerned, to your point highlighted before, Alex, that there are actually managers in the industry that used to provide drawdown protection, and investors are looking at time series. They are studying the style of those programs, and some of these managers have deviated from that historical path. And there's many ways of doing that as a CTA manager. You could prolong your time horizon, trading horizon, sorry, and with that introduce long biases and less reactivity to markets. You could, of course, include short volatility models, carry value type signals, and all of that makes perfect sense if you want to achieve higher returns.
Much of the returns over the last years, of course, came from the bond trend that lasted over many years. Some speculation that bond trend may go away. Maybe to Katie and you, Razvan, where do you think return pockets, alpha pockets are?
I think it might be interesting to first start with a review of what happened this year, because one of my internal jokes is that 2020 has been a very long decade. The reason being was that there was tons of trends this year across different asset classes. And so we divided those up into 4 quarters. Q1 was the COVID crisis. Q2 was the unexpected V-shaped recovery. Q3 was the reflation trade. And Q4 was the balance between uncertainty and hope related to the vaccine. And so when we take a look at that environment, one of the key themes that started to emerge this year, something we've been following, related to bonds. Bonds were one of the biggest contributors to trend performance in Q1, and then they basically died after April. So from a trading perspective, it was really key to trade them quickly and then forget about them. And so what we've really seen is that bonds are actually at some of the lowest signal ratios right now in the portfolio that we've seen in a very, very long time, meaning that from a dynamic risk perspective, trend signals are very cautious about bonds being interesting. Now, why is this the case? If you look at the financial markets and what's been happening over the last year, we've seen a massive shift in the world in terms of the use of monetary versus fiscal policy. As we previously in 19 and many years saw this very strong defensive trade where anytime equities went down, it was clear that the artifice of use was the bond market and that the Fed was sort of the first in line to get into the game to try and fix the markets for the right direction. Now, what we saw throughout this year is that markets started to move to being much more focused on stimulus, on this opaque concept of pushing money into the system and sort of keeping those traditional markets afloat. Now, me personally, as some of a pessimist and as a trend follower, I always think when you hold something constant, things will move. And we already started to see that this year. If you look at the US dollar, it massively sold off. If you look at commodities, they behaved wildly, whereas they were quite challenging in the prior year. And so the real themes that we're thinking about for fixed income is it may be the case that fixed income is sort of a dead asset class for some period of time. And I know here in the financial markets, we're talking about that a lot. So I think the next question is not always, is bonds going to be the best trend for the next 2 decades? It may be the case that actually inflation or some other sort of unexpected force, which is pushed upon us by this excess fiscal spending, may actually be where the biggest trends arise. And that could be very challenging for traditional investors. If you hold bonds, they may be worth very little. And in terms of equities, inflation will help us a little bit initially, but longer term, it could be challenging.
The way we see things, I think before even 2020, so towards late 2019, we did some analysis and put out a piece on a similar topic, almost like the fixed income asset class could be, let's use your words, sort of like dead, right? It could be just, we just extinguished as much as we can out of that. You know, for CTAs, a lot of the return that we've had has come from the term structure effects. So one can't underestimate how big an effect fixed income carry has been to provide stability of positions. And then also, you know, that dynamism of the yields that were able to provide protection against equity markets. And so already we were looking quite concerned at the end of 2019 that, you know, at the time the equity markets are looking pretty peaky and stretched, and there's not much protection coming from bonds. And we've seen that it was the sheer size of the stimulus in early 2020 that reflated risk assets and has actually changed the dynamic. We're seeing like Apple's putting out, you know, getting bonds at yields that are unheard of. So people are really changing where they're looking for the long duration assets. And that brings to the fore the topic of stagflation, which we think is something that might be interesting, given how much, you know, other people made the topic, the statement, CTAs are not held in isolation. No one has one investment, and that investment is a CTA. So there's a lot of equity beta, a lot of fixed income allocations in institutional portfolios. If you go to a situation where you don't expect equity markets to crash from here, let's just say they're going to go sideways, you've got a little bit of inflation, and you've lost that cushion from bonds. So whilst the correlate, you know, there's other papers and studies, and it's easy to do, to look at long-term data sets and look at correlation between stocks and bonds. It's only been a recent event that these things have been negatively correlated. So in our view, it's entirely possible that fixed income could become more like a risk asset, right? Especially as we have to like pay back the debt, inflation comes back. And so trading strategies that are not biased, that are not designed to necessarily expect that this correlation will be there, will make a lot more sense going forward. So we're looking at, cross-sectional carry models, commodity trends, all this dislocation we saw that even Katie mentioned, dollar, commodities, all these things are likely to become much bigger opportunities for CTAs going forward if fixed income remains as depressed and as sort of just driven by stimulus rather than any other need for it to be held in portfolios.
And the question, if CTAs in general are becoming too complex and moving away, we touched on it before, from their traditional role of being pure trend followers. Is everything just becoming too complicated and complex in the CTA space? And Katie, maybe we can start with you there.
Yes, I think that's a very important question, because over time, CTAs have evolved. We've developed new tricks, we've figured out new things, we've incorporated machine learning, we've done a lot of interesting things. But I think one of the core things that I always support is simplicity. And what we try to think about is, in the most chaotic of moments, it is the first central moment, right? It is basically, the simplest that usually is the start. And so when I think about any way that you want to think about measuring a trend without using the first variable to measure it, which is price, trend following models start from the basics. And so in moments when there's the most stress, when things are chaotic, when things are changing in a way that we don't like and we don't understand, oftentimes it's that first derivative that really makes sense. And so when I talk to investors about this, what I explain is that a trend following model is your first line of defense in a very chaotic environment, because it's really trying to keep things simple and try and figure out where the world is going. That being said, we can use new techniques with the proper level of skepticism, meaning that we don't think that we're going to solve all the world's problems with very complex techniques. That is a recipe for disaster. There's been a lot of challenges, and if I want to take another field in the ARP field this year, a lot of strategies with fantastically interesting investment theses, but they work very well in sample and they're complex, and out of sample, it can be a little more challenging. And so what I like about trend following is simple is good. And Alex and I has a funny joke of that, is after 800 years of data, you can see that these simple rules make sense. You can make them better, but you have to really think carefully about how complex you make them.
I take a somewhat different stance there. I think simple models, I agree with you, Katie. It has merits in certain type of environments, providing protection. Certainly, it's a really intuitive and good strategy. But over time, what we have seen is that returns are really not there. It hasn't been for many years. But let me rewind. I do think we should not use complexity as a bad word. Really, in our view, I mean, being complex and elegant is far superior to be simple and naive. And we should make no mistake that trading financial markets is a very complicated endeavor, and the competition that we face, all of us, is brutal. So what we do, we constantly invest in research and in innovation, because that's the way we believe that we could deliver returns at the same time keeping the profile of our systems intact. And to Katie's point again, complexity is never a goal in itself. On the contrary, we constantly apply the Occam's razor strictly. And that really means that any complexity that we add to our research really needs to come with a material expected improvement.
And I actually have one other, I would follow up on that. And just to clarify what I said is that if we looked at our 2020 performance, our more complex, more diversified models, those that use machine learning and also some pattern techniques and more multivariate approaches actually outperformed this year. But at the core, they're still very much based on the basic principles of trend following. and they're still within the range of trend following techniques. So how I would say it, and I often like the phrase, I'd rather be approximately right than perfectly wrong. And I think that's more a sort of a philosophical question, is that we're all looking at machine learning. We're all looking at more complex methods, but we're trying to balance the complexity with the objective and making sure that that complexity is warranted, just as Martin said. And so I think there's where, I think we have to think a little bit more going forward in terms of, and keep an eye on that. And those that don't, I think it easily can become complex.
I think you could be quite sophisticated, but not necessarily overly complicated. I think the job of our industry is to explain our performance to allocators. Remember Martin asking me questions as an allocator about why we underperformed. So I think we lose clients if we're not able to explain exactly what kind of environments we should make money in or shouldn't make money in, or explain our performance, certainly explain the underperformance. So I think we can be quite sophisticated. We, for example, use quite sophisticated optimization techniques that, Katie maybe teaches at MIT, way more complicated than we did, 30 years ago, way more sophisticated, but we can explain them well. And if we can't explain the intuition or explain to a client or attribute performance to various techniques, then we're in trouble. We can't just tell clients that we're going to just walk on water with these techniques and print money. If we print money, good, but if we don't, we lose 90% of our AUM. And I've seen it not just in the last year, but over 30 years, a lot of industry participants lose a lot of AUM because they can't explain well even small relative underperformance.
If I can add here as well, I think the word I was going to jump in was interpretability, which is pretty much what Alex explained to us so clearly. But for us, we always felt that being able to specifically isolate strategies, make them intuitive, and make them building blocks for clients to allocate to, because you have a spectrum. It's about, ultimately, you got to think from your investor's point of view and see how they want to utilize the strategies in their portfolios. And so for us, we have a spectrum of strategies that vary from how linear they are to how non-linear they are, effectively. But each one of those things need to be clearly explainable, pick up these first principle components, keep doing that same, utility throughout an investment cycle. And then the complexity comes from how the client decides to allocate to a number of things and what we can do to make a bespoke solution. At the firm, we have the majority of our investors pick up a number of our strategies. And so for us, funds are just reference points, starting points for discussion, but each one of those things are individually explainable. How you put them together, you're able to create highly complementary strategies that are tailored to a client's. And that's where I think the ability to do that requires sophistication and complexity, but not necessarily at the basic level, where we still need to be able to understand why every single position is moving at any point in time.
Are allocators after this financial shock maybe more willing to pay reasonable fees, higher fees for better, more robust, more predictable products?
No idea, unfortunately. So I've seen more investors leaving the space than entering the new space. And actually, you have not had the chance to get too many very new investors which you have never met before. So I think it's too early to answer that question. But I doubt that this trend of fee pressure will go down as long as there's still competition among various people here.
Actually, I'll just add one point that we have seen interest in investors, but it's more on the institutional side, and we've seen new investors entering. But it's much more of that sophisticated conversation, the clients that know exactly what they're buying and that want the transparency exactly like Alex said. So it's more the institutional side where they're starting to see the value of having something that might react to what could be the next decade of asset class trends, with traditional assets potentially held in check. So I think that's what we're seeing, not a discussion on fees, but more sort of a shift in interest areas where we've seen some outflows in the US mutual funds. That would be much more in the institutional large players who have kind of lost some interest in alternatives and have found the asset class challenging from return perspective. And that's been a much more challenging area for investors to understand the short-term performance differences.
No, we speak to only institutional investors. We've actually have seen some inflows and some interest, and the simple answer is higher fees are justified if you can show value added. I think it's been too easy at times in the past. We've talked about the bond rally. Katie and I have written about it till, cows come home. It's been too easy to, in the past, to capture returns with low systems. It's been too easy to deliver the kind of returns that CTAs delivered in 2008. Because we obviously had the flight to quality and we had a slow enough reversal in equities. It was a double whammy on the positive side. It's just been too easy. And some of the cheaper systems, I think, actually are too expensive. If you look at it through the lens of the benefits per unit of volatility and correlation, don't think that's the case with me, perhaps anybody on this Zoom call, but I do. Certainly with some others, I think even the cheap systems are too expensive. And sophisticated investors and the ones we talk to, they understand the nitty-gritty details. And there's a movement out there, I suppose Aspect is part of that based on what we just heard about offering customization and a high degree of plug and play. And I can see the value of that. We take the complete opposite view, that we want to be the best one holistic product, the best trend product in the world. It takes a combination of intense R&D and product focus and limited capacity and all those kind of things. And we need to evidence to the clients that we actually, within our mandate, which is low correlation and high skew and crisis alpha and all those kind of things that are implanted on my forehead, that we work hard to try to deliver those. And if we can justify higher fees, then we'll get them. We don't do simple trend beta products. So I suppose we need to do what we need to do well to stay in business.
Which innovations and opportunities in the CTA space do we see? And what's the future of managed futures?
We are seeing an evolution in the CTA space. And the evolution we've seen over some years and will continue. And it's one that it's not one strategy. We are a managed futures industry that has broadened the instrument universe to alternative markets that are no longer so alternative anymore, because there's so many of us, not Lynx per se, but others that trades them. So there's not so alternative anymore. And there's other type of strategies. We have launched a machine learning dedicated strategy. We are seeing an interest for more the systematic macro side of our Lynx program. So that's clearly something that you could construct a separate product with its own objective. But not the least, I think sustainability is something that we as an industry need to deliver on as well. It's something very impactful that is happening, and we are very excited about it, because at Lynx we have for many years tried to integrate sustainability factors, mostly in the way we manage the company. But I now see very positive steps in how we can integrate these sustainable factors in the investment strategies. But it doesn't come without challenges. There's a huge challenge to integrate them when trading macro markets.
I would like to talk a little bit more about the future and what's exciting about managed futures, because I think Martin covered it very well. But thinking about the markets and where we're going, as some of you know, our fund was founded by on the principles of adaptive markets hypothesis. And one of the exciting things about right now and where we are in history is that we're at an inflection point. We're in this point of technological change where the world is changing. The definition of homework and home versus work divide has changed. Technology's role in our lives has changed. Even this last week, having these massive moves in GameStop and silver and sort of these massively disruptive events tells us that the world is changing going forward. So I think for clients, what's interesting about managed futures and trend following in general is we like change. We like things that you haven't seen in the past. And I'm actually quite optimistic that change is disruptive, change provides opportunity. And it's those of us who have been spending our entire career trying to find the next breakout move, the next difference that may have an opportunity to help investors.
Well, I think also from a more general point of view, I think we are also in an inflection point in terms of markets. I think what we have seen over the last decades is that financials have beaten everything, and the long-only era of having a stocks and bonds portfolio, I don't know, it's coming to an end, I do believe. And I think that we have the opportunity to offer a lot more access to asset classes that are not big part of a typical institutional portfolio at the moment. And that will be the good chance for the whole space to play an more important role in the future.
Biggest change right now, I think it's a new game with bonds. I mean, we've talked about this going forward. I think as an industry, we have a chance to actually attract some of the, whether it's a little piece of the 30 or 40% from the 60-40 or 70-30 or, whatever the allocations are, attract some of that and become a real alternative. Again, we have to be transparent, as we talked about earlier. I think we as an industry have a chance to grow significantly because of what's basically the dead end in bonds that we've all talked about, and our ability to maybe make money being short bonds. What's the experience when things change? They all stay the same. I mean, change will always happen.
And there was one thing I wrote down this morning. I wanted to see if somebody wanted to say something. Katie touched on it, which is GameStop and the Reddit rebellion. We often say we have market manipulation from central banks and governments by flooding but suddenly it seems like the retail guy is able to manipulate at least individual stocks. It's quite young, but has that popped into your head yet, how that may affect markets going forward?
Yeah, we've had a lot of discussions internally about this. And I think one of the interesting points is that markets are ecologies. They're built up of different people who do different things. And that's what drives the way they behave. So right now we're in a world where we have a lot more people, frankly, and I'm maybe making a joke of this, that don't have enough things to do. And so they're actively focusing on things to get some sensation. And there is this amazing strength of social media and technology being able to drive behavior. And I think that's that was already the case pre-pandemic. But what we've really seen is that the pandemic has accelerated change in terms of the way that we live, the way that we make decisions. And so I think this is here to stay. And I think we're going to have to start thinking about this more and more going forward as the way that people are influenced to make decisions changes by the way they use technology, the way that they connect with others. So I think that's going to be a big part of where markets move.
This sort of the ability of social media to coalesce small ideas and make them seem the main narrative for short periods of time. Those are things that we're starting to be able to pick up. It's where we look for alt data sets, because that is a new emergent property of markets. And I'm not at the stage yet to profess how long that's going to be here for and how significant of a driver of markets it is, but it certainly is something, it's a new phenomenon, and it's not something that we can easily pick up with sort of looking at prices. Prices will sort of tell you what's happened, but not really what's building up. So there is a certain amount of focus at the firm on at least having the ability to try to see different points of view, because whenever the narrative changes and coalesces on some tangential idea that could be important, you may want to react to that, even if it's just for risk management purposes.
this really says something about liquidity and how liquidity can change fast. So I think our approach is that we want to see markets. We trade very liquid markets, very liquid instruments, and I do think that this phenomena that I'm not certain at all will continue or not, but if it continues, you are more exposed trading some less liquid instruments, of course, and that is for some pockets of the CTA industry a concern, a possible concern.
One thing to point out as well is last year, many of us in the CTA space, we have weathered this storm much better than the other peers in the quant space, particularly in the quant equity space and long short and many different, I mean, it's been a very challenging environment for some of our peers. And so I think for me, it's important for us to point out that our systems, our methods are much more equipped to deal with risk with all the experience that we've had over the last 10, 20 years. And we seem to have weathered what was very challenging for some of the biggest, most famous names in the industry. So the things that people never thought would see a down period or a big drawdown actually occurred this year. And so that's been interesting to me to see. And it's encouraging because it suggests that we, in some sense, have been really thinking about risk in a good way, and such that our systems were robust to such an extreme environment.
HedgeNordic, your single access point to the Nordic hedge fund industry.